Let's start with the macro picture for USD JPY. The Bank of Japan is holding interest rates steady at 0.5% and plans to slow its balance sheet reduction in 2026, keeping its tone firmly dovish. Domestic real yields in Japan remain negative, putting downward pressure on the yen. Meanwhile, the U.S. Federal Reserve is maintaining its rate range between 4.25 and 4.50%. But while it holds off on any dovish surprises, fears of stagflation are emerging, adding further strength to the U.S. dollar. The U.S. 10-year yield stays elevated, continuing to attract global capital and reinforcing the carry trade advantage in favor of USD JPY. Geopolitical tensions, especially between Israel and Iran, are fueling mild risk-off sentiment. But with Japan's policy remaining dovish, the yen's safe haven role is weakened. So overall, the macro outlook supports a medium-term bullish bias for USD JPY, driven by yield differentials and the stark divergence in monetary policy between the US and Japan.
From a technical perspective, USD JPY has been ranging between 142.3 and 146.3 since May, forming a clean, symmetrical triangle pattern. The resistance zone around 145.0 to 145.5 has been tested multiple times without success. A breakout above this level, followed by a retest of the fair value gap, would signal a strong bullish continuation. The 200 EMA on the 4-hour chart is now hovering around 145.1, aligning perfectly with that resistance zone, making it a critical level to watch. If price breaks and holds above it, that would confirm a momentum shift. Momentum indicators are also supportive. We're seeing strong bullish 4-hour candles and RSI holding firm in the neutral to bullish territory. In short, a bullish breakout setup is maturing, backed by triangle structure, fair value gap retest, and EMA confirmation. Now let's look at the sentiment and institutional flow. Recent COT reports show that hedge funds and CTAs are increasing their long positions in USD JPY, a clear sign of growing institutional confidence. At the same time, retail traders are heavily shorting near 145 and above, placing themselves on the wrong side of the trade. If smart money pushes higher, it could easily trigger a short squeeze. Options data also supports this view. Put options around 143 to 144 have risen for protection, but open interest in call options is expanding, indicating an underlying bullish institutional bias. In short, institutional flow is strengthening, retail is positioned incorrectly, and the stage is set for a momentum-driven upside move. Let's wrap it up with the recommended trade plan. The primary buy zone lies between 142.8 and 143.0, right at the institutional order block and previous liquidity grab zone. This is where smart money likely started accumulating long positions. An alternative entry can be taken on a confirmed breakout and retest near 145.1, which is the updated level of the 200 EMA and aligns with triangle resistance. Set your stop loss just below 142.3 beneath both the fair value gap and the order block zone. For targets, aim for TP1 at 145.0 to 145.5 and TP2 at 146.3 to 146.5, aligning with the upper boundary of the triangle structure. Watch for bullish engulfing candles on H1 or H4 or a clean break and hold above the EMA to validate entry. And finally, a multi-entry strategy is ideal here. Enter partially at 142.8 to 143.0 and scale in once a confirmed breakout and retest near 145.1 is in play.